Welcome to our second movie. My name is Rolef de Wijs.
And I'm Joost de Vries.
And together we wrote a book on corporate finance. And we make some movies about elements that we think are lacking in other corporate finance books. So we made an overview of 6 elements lacking in corporate finance book. Our first movie was about insolvency law, insolvency as a balance sheet concept. And today our second movie is on non-interest bearing debt. And we're actually going to make 2 movies about non-interest bearing debt. The first today is on non-interest bearing debt as a source of finance. And next will be how to deal with non-interest bearing liabilities as part of company valuation. But first, let's go to non-interest bearing debt as a source of finance.
So, non-interest bearing debt. Why is it relevant? And is it not used in other corporate finance literature? And basically, Rolf, what happens is they just use one concept, which is debt. And debt is everything which can be labeled as a liability other than equity. So they just say we've got debt and we've got equity. But if you come into corporate finance, especially in deal making, it's very relevant to understand what the difference is between non-interest bearing debt and interest bearing debt. So let me take you into the Financial Mindmap and I will show you how this works. So first the easy side, that's the green side of the balance sheet, the assets, and we've been discussing that in prior movies. So basically what you see in the mind map, we have 3 colors, 3 shades of green. So dark green means that those are fixed assets, so it's a duration, so it's for a long term attached to the company. Then we've got the current assets, so it's shorter than a year, and I made a special block in the Financial Mindmap, which is cash, because it's very liquid. And that's light green. So we've got 3 shades of green: dark green, fixed assets; middle green, current; and cash is light green. So this is the easy part, because if you go to the numbers of a company, this is exactly what you will find in the balance sheet in the annual report. But now the other side of a balance sheet. And this is where my world from corporate finance deviates from the world of accounting. So what you tend to find, so Rolf, what the accountant, so how do they look at the balance sheet from a liability perspective?
Accountants and therefore most lawyers, I think we focus on the distinction between long-term and short-term liabilities.
Yeah, of course, fully correct. So what you see is that the accountant uses the duration of debt in order to present that in an annual report. But from a corporate finance perspective, we don't care. We only take a look at the flavor of debt. So basically what you see over here at the screen, we've got the blue block, we've discussed it in the first movie, it's equity. And then provisions, I'm going to skip it in this movie, but then there's the distinction. You see interest-bearing debt, red blocks, and you see orange blocks, non-interest-bearing debts. So, and this is what you need for deal making, but also from a legal perspective, there is a very large difference between the two. So Rolef, from a legal perspective, what is the main difference between red and orange?
Well, so we start with the non-interest bearing first interest. So the red block, they get interest. And typically, but not necessarily, so typically the red block, these are the banks, they will also have security rights.
Yeah.
So, but the main distinction is between interest bearing and non-interest bearing debt, and not between security rights. You can also have bondholders that are interest bearing. But in our world, we usually combine, because it's the prototypical element. The bank has both interest and security rights. You will never see a bank extend credit without interest.
Yeah, so if you take a look at the risk profile of each block in this balance sheet, the block that bears the highest risk is the equity, right? So it's the shareholder. So what we say, and you always say it when teaching, equity is wiped out first.
Yeah. So in case of distress, in case of failure, equity is wiped out first.
Yeah. So, and then the question is, who bears a higher risk, the orange block people or the red block people? But the red block people have a lower risk, because in general terms, they have security rights. So if the company goes bankrupt, they can seize the assets and use the proceeds in order to repay their position. And in general terms, orange block people don't have security rights. So this is a difference between a risk profile and their legal position. And if you work in corporate finance, then you most definitely need this balance sheet and not the balance sheet of the accountant, because the accountant says, I've got long-term debt and short-term debt, but in fact, we don't care about the duration. It is about the flavor of debt. And very critical, there's a difference between red and orange. And in the majority of the corporate finance book, debt is just debt. And that means that they just take red and orange and they put it together and they treat it as the same, which it isn't.
But then we still haven't explained why they are non-interest bearing.
Yeah.
So what happens? So how come we've got creditors? Banks will never extend a loan without interest. So how come that these orange people don't get any interest?
Yeah, basically this is more or less what you see in reality. People provide products or services, and it is quite common that they get paid afterwards. So they get paid after a month or maybe after 60 days, and they don't get any interest compensation on that invoice. So basically for a company, this is a great source of finance. It's free money from other people because it finances part of your balance sheet, but you don't need to pay any interest on that block. So it's free money.
All right. But it's also hard to reconcile with theories of perfect markets, that everyone prices in their risk, because we see that the banks have a lower risk profile. They do get interest.
Yeah.
So you would expect the orange people, the trade creds who have a higher risk, to charge more interest. And you're saying they don't get any interest?
No, in general terms they don't get any interest, and of course they look at the risk profile of their customer. So is there a default risk and how big is the chance that I will lose my money? But in general terms, if you send an invoice, you don't add any interest to that according to the payment terms of those invoices. Maybe you put it in the price of your product, but there is no interest on the invoice. So in principle, it's free money.
From other people?
From other people, yes.
That sounds very interesting. Financing with orange block people, free money from other people. Can you show us how it works with the Financial Mindmap?
Yeah, Rolf, that's not really complicated, and it's a bit of a nasty game. So we can call this working capital management, but basically what it is, you start working on the payment terms towards your suppliers. So, for example, you used to pay your invoices after 30 days, but then you decide to make it 60 days. And then what happens, your suppliers, these are in the orange block in your balance sheet, and by postponing to 60 days, this orange block just grows, right? It goes up. And the money that you didn't give to those people at day 30, it just ends up over here at your balance sheet as being cash. So you're generating cash by postponing payments towards suppliers. So this is what happens.
All right. Still a bit enigmatic. So don't they get paid, or do they get paid?
Yeah, of course they get paid, but they get paid 1 month later.
All right.
So this is what happens. And of course, for a company, this is a one-time thing that you do. And then afterwards, you have to keep that payment terms at 60 days. So it more or less refreshes. So you pay one after 60 days, but there are new goods or services delivered. And therefore, there is a new supplier coming in your orange blocks. So if you
So it's a one-time cash gain
Yeah.
for the... Could you do this again after 60 days?
Well, you might try to postpone it from 60 days to 90 days. So, and we've seen this in reality, that people tried it and it worked for 60 days and then, well, give it another try. Let's free up another 30 days in cash and postpone it to 90 days. But you should imagine that the gain of the company that works on the orange blocks is additional cash, but it's the loss for the supplier that needs to wait longer for the money to come in.
Yeah. So what could you do with the freed up cash? So what will typically happen with it?
Yeah, everything you can do with cash. So if you go to a balance sheet, you can do a whole lot of stuff. You can buy new inventory, you can buy new assets, you can pay dividends, you can repay your loans. So there is a huge amount of possibilities. But if you just make it easy, you can say, I can use the additional cash to repay my interest-bearing debt. And then you see this division or a difference and a movement from orange to red. Right?
All right. Can you show us with the Financial Mindmap that we get a feeling, because we now just postponed, we created cash by postponing payments to the orange block.
Yeah.
Can you show us how the balance sheet looks like if we use this cash to pay off interest-bearing debt?
Yeah, well, let's assume that you do another 30 days additional, right? So the cash, you don't use it to put it on your savings account, but you just use it to repay your interest-bearing debt. And this is what you do then. So there are two flavors. It goes to the cash position, or you use it to repay your debt. So that's the basic flavor.
So this is your free money from other people.
Yeah.
So now you finance increasingly your activities with money from trade creditors.
Yeah, which is great because you don't have to pay them any interest.
Yeah.
So if you can choose between red blocks, banks that you need to pay interest, or people that provide free money, what would you do?
Yeah, I think I would go no.
Yeah, no. So, but from my perspective, so this is the finance perspective. But my question from a legal perspective is, how does this work? Can you just keep on postponing payment towards those people?
No. I think there's a policy discussion before that. So you can ask yourself the question, is there something wrong with this? Should the legislator intervene? So I think the picture is very clear now that although we think that banks are financing companies, it's also the trade creditors that are financing companies. But they're not the most likely or the best risk bearers. So you can also say, I think that these people are being bullied into the capital structure. So it's also very much a power play. So it's either take it or leave it, right?
Yeah, that's in reality, of course, is what you see is that big companies say to smaller suppliers, you can supply, but these are the terms, and it's 90 days. And once they are supplying and a huge amount of their turnover is that big customer, then the chances that they get squeezed again, because they don't have any alternative scenario anymore. Because if they stop, they go bankrupt. So this is tricky.
Yeah. So you mentioned 60 days, 90 days. I think we also came across examples of more than 150 days.
Yeah.
So this is happening, and the question is, you asked me, are there rules or should there be rules? Well, at least at the European Union, we have the Anti-Late Payments Directive. So basically pushing back against this whole game, because everybody's playing it against each other. So they always try to push it down the value chain. In the Netherlands, I think we try to push back even further. So in the Netherlands, there are rules that you already mentioned. It's specifically a game of big companies played against small suppliers.
Yeah.
And then you also see that it's very strange that these small suppliers are basically financing the activities of these very large companies. So the Dutch legislator is pushing back increasingly. And now, if you're a small company, make supplies, you are entitled to get payment after 30 days. And otherwise, it becomes interest-bearing debt and for a very high rate. But then the question is, there's still a power play. So you could, of course, sue the big company, but then there's the question, will you still have a customer?
Yeah, do you dare to do so? So what we try to show over here is that the position of orange is one that is used by big companies to a large extent in order to generate free money, because it's non-interest bearing. So that's a nice option, and this results in frictions and in risk shifting. And those people in the orange block, in general terms, they have limited amount of collateral. So their risk takes a huge blow if things go sour, right?
Yeah. So you can ask, so maybe the banks typically have security rights, right of mortgage, right of pledge, or for common law, floating charges. Of course, in theory, these trade credits can also have security rights, but in general, they don't. They don't have the bargaining power. Of course, you can negotiate for retention of title, but one of my favorite examples was also that these big corporates, they're even so aggressive sometimes towards their suppliers that say, you can only make deliveries if you waive your retention of title.
Yeah.
Because then we can give more collateral to the bank. So the frictions you are mentioning are not just in the finance, but also in the security rights entitlements.
Yeah. So if you see an orange block which is stretched with payment terms, there can be two scenarios. One scenario that the people use their bargaining power to do so, and the other scenario, we discussed it in the first movie, is that it's stretched simply because those people don't have the money anymore to pay their suppliers because they're in financial distress. So these are the two scenarios that you can come across with big orange blocks.
And typical pre-insolvency scenario.
And typical pre-insolvency scenarios. That's true.
All right, thank you.